Welcome to the Multifamily Investor Nation podcast. I'm your host, Dan Hanford, and with me today is our guest, Anthony Vicino. Anthony, welcome to the podcast.
Hey, thanks for having me, Dan. It's good to be here.
Awesome. Well, I know we have this acquisition called Charles Avenue, 55 units out of St. Paul, Minnesota, that we're going to be diving into. And something unique about this one is that you just signed the paperwork today and closed on this one. And it's been a long kind of process, like you mentioned earlier in the green room with me a little bit, about a 5-month process. But before we dive into that, because I'm very interested in what happened during that entire acquisition. But before we do that, why don't you share with the listeners a little bit about yourself and your background and where you are right now on the multifamily side of things?
Yeah. So this is going to be a cool story to share on Charles. The ink is still drying on the paperwork, but before we get to that, for me, the thing you got to know is that I have like severe ADHD. And so what I tell everybody is that coming out of college, I knew that the corporate route was never going to work for me. As like a really bad employee. It was just like unreliable, didn't really put in a lot of work. I was kind of lazy, but when it came to working for myself, I was like very, very hardworking. And so that led me down the path of not so much entrepreneurship, but just seeking out ways where I could control my time, my energy, where I was focused and what I was doing. And so for a number of years, I was a professional rock climber, and then I started writing science fiction and fantasy novels, and those were all great. But it wasn't until a buddy came to me one day and said, "Hey, I'm building this business. Do you want to try doing that with me?" And it was a high-rise window washing company that uniquely suited our skill set as rock climbers and our network of rock climbing friends. And so we did that. That did very well. And that was when the bug really bit for me, where the entrepreneurial bug, at least. Like when I was a kid, I wasn't the kid pulling up flowers and selling it back to people. Like that wasn't me at all. And so from there, I realized that I had kind of a knack for the marketing, for the operations and building companies. And so that's what I've been doing for the last, I'd say 12 years now, is just building companies. And it wasn't until about 5 years ago that I finally took notice of the universe trying to put real estate in front of me. So when I was in college, my roommate and his dad were fixing and flipping houses. We were living in it for cheap, doing construction. And all I learned from that was that I can swing the hammer, I can't hit the nail. I absolutely hate construction. So my experience with real estate was, that's not for me. And then about 10 years later, a buddy comes to me and says, "Hey, I'm buying these quads. Would you like to do that together?" And I still kind of had this negative impression from before. So I said, "No, I don't want to do that, but I'll fund you. I'll give you some money." So I was passively investing before I even really knew what that was. And then 5 years ago, the story that I tell people, I don't even know if this is accurate. Like, I don't know truly when the light bulb went off, but I tell people I was driving into downtown Minneapolis, looked up at the skyline and was hit with the question, who owns all those skyscrapers? Like, is that a business? Is it a person? Is it an entity? Like, I had no concept. It was the first time in all my years on this planet where for the first time, I looked at the world and I was like, who owns all these buildings around us? Like, who does that? And so just trying to answer that question was really interesting. And I discovered it's people like you and me. Like, yeah, there's rich people. Yeah, there's companies, but there's also this niche of people just like us that are going out there, pooling their time, their experience, their resources, their capital, and they're buying these things together. And that was interesting to me. So I was like, I want to do that, but first I want to learn how to do it on my own dime, on my own buck, on my own sweat. And so I went and started small with a triplex, house hacked that thing, and then started scaling from there until I couldn't scale with my own capital any further. And that's when we formed Invictus and started syndicating and working with passive investors. And that's where we're at now. We're at about 200 units here in the Twin Cities. We're vertically integrated. So we're kind of control freaks. We want to control every aspect of the resident and our investors' experience. And so we've been building that in-house as well. And so that's kind of a unique thing about how we operate up here.
Awesome. Well, let's go, without further ado, let's go ahead and dive right into this acquisition. Obviously, it's not your first rodeo when it came to this acquisition. So why don't you first walk us through, and again, this is called Charles Avenue, 55 units out of St. Paul, Minnesota. So talk to us a little bit about how you actually located and found and sourced this particular deal.
So up here, the unique thing about the Twin Cities is that a lot of people sleep on it as being like a pretty solid market in terms of investment potential. And so there's not a lot of people looking from outside the state. And that's a good thing for us because a lot of things trade locally. You got to know the people in the market. And there is probably like 10 guys and gals who they're just they've been in the game for 30, 40 years now, and they control the vast majority of inventory here in the Twin Cities. So this deal is one of those guys. And we've kind of created this niche for ourselves amongst these older investors, where they're starting to offload their portfolio, starting to go off into the sunset a little bit, and they want to have the new young bucks that they can transact with, who they know are going to close when they say they will. And we've kind of like created that relationship with a lot of the old guys here. And so they come to us now when they have these deals. And this is what this deal was, is like an old guy who, he didn't want to sell it, but he had his partner had some health issues. They needed to get out of it so that they could free up some capital for that, which is, it's a real bummer. But when there's chaos, that usually represents an opportunity for somebody. And we're really fortunate that was us. So we walked into these assets that were really well maintained. The guy really had no intention of selling it. If you look back a year ago, he dumped a ton of money into just keeping these things upgraded in ways that you wouldn't do if your only goal was to drive NOI. He was, spending money on tuck pointing and on the common areas, just making things nicer, not necessarily for the sake of generating more value, but just trying to take care of the buildings because he planned on having them for a long time. So when we got that call, we saw a great opportunity, and it's like, we can also help him because he was in a situation where he needed some help.
So at what point, when you first heard about the opportunity, at what point did you go and actually tour the facility?
Same day. So that's one of the things about being, we invest in our backyard. So we know our neighborhoods and we can get to these properties really quickly. We try to respond quickly when, certain people call. And so we were there pretty much the same day looking at it, if not the next day, driving the neighborhood. We were already pretty familiar with it. And, the guy actually had a knee surgery like later that week. So that actually delayed getting it under contract and getting our due diligence team in there, because we wanted to wait until he was recovered a bit before, because he really wanted to walk each unit with us, which is kind of cool. Like, these old guys, they take a lot of pride in their properties. They're like telling you all these cool stories. And so you can learn a lot if you just sit there and listen to them, which is a lot of fun.
So even this one being kind of off market through one of these old guys in town that kind of has a hold on the market, if you will, with these types of assets. When he reached out to you and said, "Hey, we have this asset, 55 units. It's called Charles Avenue. Go take a look at it. I'll give you a tour." Did he tell you a guidance of kind of what he was looking for from a sale perspective?
Yeah, so he kind of he pegged it at he would be happy to get out of it at around 107, 108 per door. And in our market in that area, that's an easy hit for us. So we look at that and we're like, okay, that makes a lot of sense, even without having seen the properties, because we control, I would say, 80 units across maybe 4 different buildings within just a handful of blocks of that property. So we're really familiar with that neighborhood, what it pulls down in terms of rents. And we knew that asking price was going to be very competitive and hard to beat, period. And then when we went over there, saw the condition of the properties and that they were really well maintained, we're actually like, this is going to be a pretty good steal. So we didn't even go into any kind of negotiating with them. Well, actually, I think we came in just 1,000 under per unit, because it always feels good to feel like you haggled a little bit. And a lot of these old guys, here's the really interesting thing about these old guys, is they want to feel like, a lot of them, they've been doing this for so long, they just want to play the game a little. They want to have a little bit of a haggle, but they don't want you to be a pain in the butt. So like, you give them a little bit and you play that negotiating game, and they kind of like that.
And so that would be about 106,000 a door. Is that what you said?
Yep.
So right at 5.83 million.
That's exactly it.
Okay, good. So right at 5.83 million. And were there any others that he had sent the deal to kind of take a look at, or is it just your group?
So he sent it to one other group. He got back an offer on that one, and their offer actually I think they were offering 109. So they came in higher. But again, with these older guys, it's not so much about the top dollar. It's about the ease of the transaction in a lot of cases, and knowing like you're going to get the deal done. And that became a really important point for us, because this deal took 5 months and the closing just kept getting pushed back through. We'll talk through like what was occurring in those situations, but throughout it all, we just kept reiterating, like, we're going to get this deal done. We're not going to walk away from this. We're here to see it through.
And what kind of what class of asset would you say this is?
I would say this is solid C plus maybe, in a B area that is It's called the Midway neighborhood. It's smack dab between St. Paul and Minneapolis, and it's about 2 blocks away from the new Allianz soccer field. And it's just littered in opportunity zones. It's one of those areas that everybody looks at and says, in the next 5 to 10 years, with the amount of money being poured into it, it's going to be the next hotspot. So we've been very actively acquiring assets in that neighborhood for a while now.
Okay. And walk me through a little bit about how many rounds of offers did you go through, or was it just like a 500, 5.285 or $5.83 million offer, and he accepted it and it was done?
Yeah, it was a pretty much a one shot, one kill type of situation. He said when we were doing the tours, he was like, a 107 would probably get it done. And then when we submitted our offer, we said 106. And he said, okay, let's do that.
Okay. And what kind of other terms were in the offer as far as earnest money deposit and how many days for due diligence and days to close and any extensions?
So on the earnest money front, we put down 35,000, so nominal, not even 0.5% really of the total purchase price. And so that's a pretty clear sign of faith on his side that he had confidence that we were going to get this thing done. I think the due diligence period was 30 days with the idea of closing within 60. So we put this under contract in March and anticipated a June 1st closing date. And if you had asked us in the beginning of May, we were anticipating even moving that forward to mid-May. And so, we're a small crew. And we have a lot of capabilities in-house. So we have our architect, we have our engineers in-house, so we can get out there and do the due diligence really quickly. We can do the financial due diligence really quickly as well. So we don't need a long runway on that stuff. And generally, because we operate in this area with this asset class so much, we're pretty familiar with a lot of the issues that we're going to run into. And so there wasn't a lot of question marks as we were doing due diligence of like, what's this going to look like? What's that going to look like?
And as you're going through your due diligence, was there anything that you found that was kind of, some of the reasons, or kind of, I guess, let me back up for just a minute here before we go through that, and walk us through what were some of the reasons why you had to delay?
So the delay was entirely from the bank. And this is the first time this has ever happened to us. And it happened twice on this deal from 2 different banks. And it was really interesting. It's an interesting learning experience when things kind of happen outside your control and you're just left there scratching your head. So in the first instance, we were using a bank that we have a great relationship with. We did, I would say, 2 deals in the last 6 months before that with them. They offer great terms. They're fantastic to work with. As we started going down the process with them, at some point they said something to the effect of, just so you guys know, we're starting to pull back a little bit on multifamily because we're a little bit too heavy into multifamily in this area. So in the future, like, you might want to start priming some of your other banks just to let them know, because they were kind of our go-to at that point. And we're like, okay, that's interesting. And this was right around the time that we're starting to get a lot of the inflationary data about like, oh, things are, spiraling a bit quicker than we had anticipated. And so there was a little bit of like spooked, I would say, ness in the conversation that we're having with the bank, but they didn't say anything that led us to believe like they were going to pull out. And so we get to about 2 weeks before closing and they come back and they suddenly change the terms. And before it was a 75% LTV, and now they were pushing for 65. And we're like, oh, well, that's really interesting. 2 weeks before closing, we've raised all the capital. Like, we've already pro forma'd this thing out. Like, it doesn't work at 65. And so that's a no-go just out the gate. And from what we can tell, we haven't had this conversation with them to like really get the deets, but from what we can tell, they just wanted to be even more conservative than usual. And so they got spooked from the inflationary data, did that. And that's not a big deal. So we go to the seller, explain the situation. And he says, not a problem. I have this other bank, fantastic bank to work with. I've been working with them for years and we have no relationship with them. And this is the big lesson here, is be careful when you're working with a bank for the first time if you don't have a relationship with them, because it's a two-way street. You need to know them and they need to know you. And there's a lot of trust that goes into that. But he was vouching for the relationship. Well, we literally got to the day before they were going to vote as a board to approve the loan, which would have been a week before the final closing date. And they come back and they were like, oh, we didn't realize you guys were syndicating this. We didn't realize that you had passive investors involved, which was very strange to us because we were like, we showed you the marketing package. We were very clear up front about our whole business model. And so that created issues suddenly because not from their standpoint, but they were a small bank and they were doing a participatory loan. So that meant that because of the size of the loan, they were going to cover, say, 3 million of it. And they needed another bank to come in with another million to cover the remainder. And lo and behold, they go to the participating bank, and the participating bank knew nothing about the syndication model at that point. So they got spooked and they said no. So now we're back to square one twice now, right before closing. And we're just like, this property, like something where it's cursed, like there's something about this that's cursed. And so we go back to the seller again and we're like, listen, we're going to get this done. Like we're committed to getting this thing done. We put up even more earnest money to like show our confidence that we're going to make this happen. So we put in another 15,000 on top of the 35 that we already had in there, bringing it up to an even 50 now. And we go to the bank that had been our second choice back in March. And they got it done. They got it done in a 2-week period. So this originally we're supposed to close on July 1st. Like at the end of June, we get this news from the small bank. They can't do it. So we call up our backup bank and we say, hey, we need to get this thing done quickly. We got an anxious seller over here. And here's the thing too, is that we had already raised all the capital all the way back in April. So we're sitting on over $2 million of investor capital. And I'll share like how we resolve that situation with our investors as well, because it's important to know, like when you're sitting on people's money, like they're expecting returns. And so our bank came through, they got it done in a 2-week period. We closed today. And it feels really good to finally get it done because a lot of things just seem to be getting in the way and we're like not entirely clear why. But that's kind of the long convoluted story.
Yeah. So of that 35, then the additional 15 of the earnest money deposit, which brought it to the even 50,000, was that non-refundable?
Oh yeah. And here's the thing. Here's the really fascinating thing about the terms that we had negotiated, right? We've always put a financing contingency into our purchase agreements. So technically, at any point, we could have backed out and been like, listen, the financing is just not coming through. We would have been well within our rights at that point. And we had a conversation internally, my partner and I, and we're like, how would we feel if we burn this relationship over $35,000 and just decide to walk away and leave the guy holding the bag? Because technically we could, but then we would have just strung him out for, 4 months. And we had made the decision that we were going to double down, put our money where our faith was, and that if it didn't shake out how we thought it would, that we were taking that hit individually. Like my partner and I ourselves, we were going to take that. We weren't going to use that escape clause in the PSA. We were going to do right by this guy, because this is the thing with these old sellers is faith and trust and doing what you say, like doing the honorable thing of like your word is your bond, goes a really long way. And if you burn this one relationship over $50,000, nobody else is going to transact with you. And so we're in a situation where like, we're not going to do that to the guy. Let's show him that we're not going to. Let's put our money where our mouth is. And thankfully it didn't come to that. But because I think other operators maybe it's a hard thing. I don't think you can judge anybody if they would have executed that clause. But for us, we try to play long-term games with long-term people as much as possible and keep the eyes on like, what's it going to look like in 10 years rather than this one deal.
Well, it's about the reputation, right? Just like you said, you got to maintain that reputation so you can, maintain that with your investors, but also with the sellers in those areas. And then even if you start to work with some brokers in those areas as well, they're gonna talk, right?
Yep.
And so that reputation is going to be very vital there. Let's talk a little bit about the business plan on this property. So first off, what are the average effective rents on this property, and what's the unit mix?
So the unit mix on this one is entirely 1 bedrooms. The rent comps here is on the one bedrooms, about $830 per unit. In that area, the market average is about $970. And so when I say market average, we're actually baselining that off of our own properties and a couple others being operated by other operators in the space. So like those aren't just theoretical market numbers, those are numbers that we're actually achieving. So there is about $140 delta just right there of room. And I would say these units were actually in better shape than some of our current portfolio. So we were coming into it thinking we can at least hit what the rest of our portfolio is doing. But in the back of our mind, we're projecting closer to 1,000, or if not over 1,000. But we never lead with that to investors, and definitely not in the marketing package. We really like to set the bar and expectations low and then over deliver.
And walk me through what the plan is for renovations on these one bedroom, one baths.
Yeah, so most of the work they're really well maintained in the common areas and the living areas, but the bathrooms and the kitchens in these old buildings tend to be where the opportunities lie. So the bathrooms are a little bit old, a little dated, like they need better flooring, they need better appliance or better fixtures. The kitchens, they need a little bit of renovation in terms of the appliances, the cabinets, things to spruce it up, because that's really where the most bang for your buck is going to go. So I think overall we budgeted between, I think around 4,500 per unit, but honestly with the amount of work that needs to go into these, we're thinking it's going to be lower than around 3,000. So there's a little bit extra room in the CapEx budget there. There's really no work to be done in the common areas on the mechanicals of any sort, that with the exception of windows. And windows are always an interesting one because these buildings, they're old. Like in St. Paul, Minneapolis, if you guys aren't familiar with it, they're old cities. Like there's not a ton of brand new inventory. We have these buildings that are built like tanks from the turn of the century, and they're great, but the mechanicals are usually the issue, the internals. This one has been really well maintained and even updated in recent years. The electrical is completely redone, so there's really no work there to be done. There's one roof of the 4 buildings that's going to probably need to be repaired in the next 6 years. But besides that, the other 2 of them were freshly new, and the other one's in just solid shape.
And what was the overall amount that you ended up raising on this project?
$2.25 million.
Okay. And walk me, before we go diving into the investor setup and everything, what were the final terms on this particular property as far as from the lender? I know you mentioned 75% LTV. Did it end up being 75?
Yeah, they did.
A little better, or?
Yeah, actually, so here's the really cool thing. Like that horror story is one thing. And we thought we were going to be in a position where the terms were going to keep getting worse because like a new bank was going to step in, but the terms actually got incrementally better somehow. So the interest rate was 3. Let's see, what is it? We had budgeted where we had performed it at 3.5%, but it actually came in at 3.35. So it came in lower than what we had been budgeting. We had only anticipated 1 year of IO. We ended up getting 2 years. It was a 75% LTV. The one thing that changed was the term length. So originally what we were anticipating was a 10-year term, which is nice. This one is a 5-year term, but there is no balloon. It just resets at that point. So, whatever the average is at that point, plus some basis points. For us, what we do with our business model is all about the cash out refinance. We don't model that in and project that for our investors typically, but we're always anticipating in year 2 or 3, we're going to go in there and do a refinance. And so this is a prime candidate to refinance into long-term debt at that point. And so that's what we're going to do. And there's no prepayment as of year 3 coming into the loan. So that's really helpful.
And was the interest rate fixed or floating?
Fixed.
And is it still fixed even after
floating at 5 years? At 5 years, yep. Okay. So it becomes fixed at 5. Well, so it floats to whatever at 5, and then it stays fixed again. Yep.
Yeah. And is it prime plus a certain amount or SOFR plus a certain amount when it gets to that 5-year term?
Yep, that's right. I don't remember off the top of my head what that is. My partner Dan's more of the numbers finance guy. The other really interesting thing was the 30-year AM, which we've been getting a lot of recently. And I would say as of like a year ago, we couldn't find anybody to do a 30-year AM on this type of a loan. And now we have a couple banks that have lined up on that one, and that's been super helpful actually.
That's good. No, that's definitely nice to have that in the pocket there. 2 years IO, 75% LTV, great terms there, 3.35% interest, 5-year, or really kind of a 5-year term, but you can, like you said, move it on past that.
Which is nice because you don't really want to be caught with your pants down having like a balloon in year 5. Like that would have been terrifying. Like I don't know if I would have pulled the trigger on that one. If like we would have had a balloon at year 5, that it would have been a little scary for me.
Yeah, no, it's definitely challenging to make sure that you time that properly. What's the plan? I know I didn't talk about this earlier when you're talking about the renovations. What's the plan for completing the renovations? What's the schedule there?
So this is something that we changed our thesis, I would say, in the middle of COVID. So we closed a deal in January of 2020, right before COVID happened, that was heavier value add. It required getting in there, moving out all the really bad tenants, which there was a lot of bad tenants, doing the renovations, and then bringing it up to market. It was one of the classic examples of like worst building on a great street. And so tons of meat on the bone, lots of opportunity. Then COVID happens, eviction moratorium goes into place. Suddenly doing these renovations and moving tenants out becomes a little trickier. And that ended up not really being an issue for us. But moving forward from that, we decided let's make a play that doesn't require such heavy value add and reliant on moving tenants out. Let's find assets that are already performing well. They need some improvements, but the returns aren't predicated on doing those improvements in year 1. And so we did an asset acquisition in November of 2020. And then this one where there's good tenants already in there. We don't need to go in there and do the renovations to justify the rent increases, because one of the things that this seller did at the beginning of COVID, which was interesting, was he across the board went to his tenants and said, I'm lowering rent by $30 per month to help you guys. Like a good show of faith, like $30 goes a long way at that I would say that demographic. And so it was always with the idea that as COVID started to, the effects of COVID starting to open up or lessen, that the rent would go back to where it was. And so when we acquired the asset, that's like the easiest thing right there is now just go to have those conversations with the tenants. Rents are going to go back up to $30 like you guys were anticipating. And from here, now we just wait for the units to organically turn over. So we see about 30% organic transition every year. So as those tenants leave, we move in and do the renovations and then move in the next tenants. Because for us, we found that unless we're able to go in there and justify some really big rent increases off the back end of the renovations, it's usually better to not create the chaos of turnover prematurely. Just wait for the tenant to leave and then do the increase at that point. Try and get the little rent bumps as you can. And maybe that encourages them to leave a little bit early, which is fine. Then you go do the renovation then. But we really tried to maintain, I would say, equilibrium in the assets where we're not getting a lot of turnover at any given point.
And so how long, I might have missed it, but how long, months wise or years wise, are you projecting to complete all of the units in the renovations?
So all units on this one will be done, I think, at the end of year 2. So projecting, and that again, there's a little bit of wiggle there. If we have tenants that don't leave, they don't want to leave, then those renovations won't get done. And that's fine with us. As long as we're getting the rent premiums that we're expecting. So I would say at the end of year 2, beginning of year 3, and that's in line with our anticipation of the cash out refinance as well.
And so that's roughly about 2 units a month that the plan is as far as the renovations are concerned.
Mm-hmm. Yep.
Yeah. And how long are you guys projecting it'll take you to renovate a unit?
So right now across the rest of our portfolio, a unit turn takes us about 4 to 5 days. And that's a function, again, of having the team in-house and they understand exactly what the work is. And we just kind of execute the same plan every single time. In the middle of COVID, that changed a little bit because getting the equipment was actually quite difficult. Getting a refrigerator in June was like impossible. So that like set things back a little bit. But generally, we're able to get the unit turns done within a week.
Okay. And when you're doing these unit turns, are you ever doing it while the resident is still in the unit, or are you always making sure you only do it if the resident has decided to leave and you're going to get a new resident in there?
Yeah, so what we have done is we'll renovate a unit, say across the street or across the block, not the block. What am I thinking about? The hallway, just across the hall. And then we'll go to tenant and say, hey, this is the same unit. If you want to move over into that one, great. And they're like, generally they're like, oh, cool. New unit. It's maybe $50 more per month. Yeah, I'll do that. And then once they move out, we go into their unit and do the renovation there and then find a new tenant for that one. So that's how we've kind of overcome that in the past.
And I know you mentioned being vertically integrated, so you're doing your own property management. Walk me through what you're doing on this property, because obviously I wouldn't think there's enough real kind of economies of scale with just 55 units have on-site property management, but I could be wrong. So walk me through what you're doing right now as far as the property management.
Yeah, that's absolutely right. I would say a property doesn't really justify having on-site until you get to at least 90 to 100 units, probably. At that point, you can have one leasing, one or one maintenance person. For us, one of our limitations is the fact that, again, St. Paul, Minneapolis, they're old cities. They don't have a lot of inventory of 100, 150, 200 unit complexes. So there's a lot of these smaller buildings. And this is where we've really carved out our niche, is in the 20 to 50 unit space. And then we cluster them. So like I mentioned before, we have a bunch of assets already in this neighborhood. And so if we can keep them close together, then our crew can functionally operate as though it was one big entity. And so that's how we overcome that. And one of the interesting things about this building is in the basement, there was unused office space. It would be really hard to lease out to anybody, but it's great for our property management team. So they're actually going to be living in the basement of Charles.
Okay, awesome. So let's move over to the capital structure, if you will. How did you end up structuring this deal with your investors to be able to raise the $2.25 million for the raise?
So our big thing is we're really simple guys. Like, the reason that we got into the syndication model was because we come from families that don't have a ton of money. I have 6 siblings and they're not very good with their money. And we wanted to provide an opportunity for our family and friends to invest with us. And so because a lot of people aren't familiar with this vehicle, we don't want to make it convoluted and hard to understand. So we keep it pretty straightforward. We always do a 75-25 split with a 7% pref. Really simple. There's no hurdles. There's no catch-ups, nothing like that. It's just 25% goes to the GPs, 75% to the LPs, 7% pref. And there's no buyout. There's no, dilution of shares upon a refinance or anything like that. We want our investors to be in these deals with us until the very end and have all the benefits that come with that. So.
And on your 7% pref, is there also a GP catch-up on that as well? Or is it a true preferred return?
True. Yeah.
So you definitely do have a hurdle in there. So there's not more than one hurdle, but so the first hurdle would be a 7% preferred return. So 100% of the cash flows go to the investors. You have a single hurdle at 7%, and then the remaining amount split 75-25 after that first hurdle.
Yep, that's correct.
Okay, good. That's a decent setup there. So great to. Let me ask you this: where did you find your investors on this project, and how long did it take you to raise the capital?
So this was our quickest raise, but it was also our biggest raise by quite a bit. So we had done 3 syndications before this, all raising around $1 million to $1.5 million. And in the early days, it was just friends and family and referrals. And then we during COVID, we really leaned heavily into the fact that there wasn't a lot of deal flow. There wasn't a lot of transacting. And honestly, we weren't super confident in doing deals at that point. So we used that time to build a thought leadership platform where we started a podcast, we wrote a book. We've been very, very active in the digital domain, and that's been bringing in a lot of investors for us. So this raise of $2.25, we raised that in a month, which for us at that was our biggest raise. That was a pretty quick raise too. I would say it's split at this point between people that are referrals or first ring network. So like this person's invested with us before and then they made a referral. That's a gold mine of opportunity when you can deliver great returns to somebody and they're like, hey, you should talk to my buddy. That's a great situation. So I would say half of our investors come from that, and then half are coming from, I would say, having some kind of experience with our platform online.
Okay, good. Well, can you think of any other issues that might have come up during this entire process of acquiring Charles Avenue? Can you think of anything that we have not touched on yet that might be interesting for us to kind of talk about or for the listeners to hear about?
That's a good question. Honestly, like the biggest, craziest part was really the banking situation. And the big takeaway here is the patience of the seller and like that relationship. And because I think a lot of sellers in that situation would have just been really frustrated going from like a June 1st closing to a July 1st and then mid-July. And like that doesn't seem like a big deal, but it is a big deal when there's like $6 million on the line. And so really, I would say maintaining that relationship with clear, open communication at all time. Like we never tried to hide anything from the seller, just was very open and honest about here's the situation, here's what we're doing to fix it. And it's the same thing with investors, right? Like when these things aren't going well, having that conversation, here's the situation, here's what we're doing to fix it.
Yeah, I was gonna say, I think another kind of thing we don't really talk about too often is, we talk about broker relations, right? We talk about investor relations, but in a situation like this, it's really all about the seller relations, right?
Mm-hmm.
Trying to figure out how to actually handle a seller when you're having to go to that person and saying, "Listen, I can't execute, but it's not my fault, right? And can you help me? And I still want the deal, and don't give it to somebody else."
Mm-hmm. Yeah, and you have these questions too, like as the GP, like syndication is like the really sexy thing for everybody at the moment. But I would encourage new active potential syndicators to like really think about the fact that your job in all of this is to get the deal done. Like that's what you're coming to the table, and you're presenting a great deal, great opportunity to your investors. And so when these obstacles occur, and they will inevitably occur, your job is to figure out how to get through them or over them or under them or around them. Like that's what you're there to do. And so there were some periods of time where I was very frustrated and kind of like bummed out, like, oh man, what are we going to do? But then that's at the end of the day, that's what you're getting paid for. Like that's the value you bring to the table, is getting the deals done. And honestly, now the work begins. Like getting the deal over the table, over the finish line, that's the easy part. Theoretically, it's now actually executing the business plan. That's the hard part. So buckle up, let's go.
Yeah, that's right. Well, one thing we didn't touch on yet is something that you mentioned you wanted to make sure we covered, which is about the investors, because obviously you held onto their capital since April. What did you do to kind of at least somewhat make them feel better or get a return because you held onto their capital for so long before you closed?
Yeah. And this is, man, the way that I look at it, like there was a time in my life when I was like super broke, right? Like I was $80,000 in debt when I was in my 20s, and I was living in the back of a van. My fiance left me. It was a horrible time. And so I remember exactly how valuable a dollar is, like, and how far it can go. And so when our investors give us their money, we look at that as like a very sacred responsibility of like, we need to do right by this. We need to honor this. We need to deliver to the best of our ability. And as we're sitting on that money, nobody ever plans for closing to take longer than expected, especially 2 months longer. And so we looked at it and said, what can we do to do right by our investors? And we decided that we were going to offer them just a simple interest on the money that's been sitting there for the last month. Like we anticipated the property was going to close in June. It didn't. And so our investors had the expectation that they would start earning their preferred return at that point. And so what we did is we prorated the preferred return and said, we're going to still pay you for that month that we didn't have the property under contract. And so if the property didn't close, we were going to be paying that out of pocket, like out of our own funds. And so there was a very real threat that we put more earnest money into the seller. We also made this commitment to our investors that, hey, if this deal doesn't close, we're still paying you. Like you're still getting your money for your return for the money sitting there.
No, that's definitely good. So you basically were paying them the preferred return during that period of time, even though you hadn't closed yet.
Exactly. Yep.
Yeah, no, that's good. That's good. Well, I have no other questions. I really want to thank you so much for being on here, Anthony, and sharing all these different golden nuggets about this acquisition. I know I've learned a lot. I know our listeners will as well. How can the listeners reach out to you if they have further questions for you about this acquisition, or maybe they want to continue to follow you more?
Yeah, so you can find us at invictusmultifamily.com. We're on social media all the time, so you can find us LinkedIn, Facebook, Instagram, wherever. And then if you're interested in just learning more about passive investing, like you guys have a killer platform, tons of resources. Another one that we're trying to add to the community is Passive Investing Made Simple. So it's a book that comes out in August, and hopefully that helps somebody, demystify or take a little bit of the complexity out of this thing so they can feel confident moving forward and investing in these incredible vehicles.
Awesome. Awesome. Well, again, thank you so much, Anthony, for jumping on and sharing the information about this acquisition over in St. Paul, Minnesota. Looking forward to continuing to follow you as you close more deals and also having you back on for a future episode.
Thanks, Dan. I appreciate it.
All right. Thank you so much.